Question 1. An investment advisor who takes custody of client funds or securities must adhere to specific requirements under the Uniform Securities Act. Which of the following is not a requirement for an investment advisor with custody? A. Maintaining separate client accounts. B. Notifying the administrator promptly upon taking custody. C. Sending quarterly account statements to clients. D. Undergoing an annual surprise examination by an independent public accountant. Answer: C. Sending quarterly account statements to clients. An investment advisor with custody of client funds or securities must ensure that client assets are segregated and protected. While a qualified custodian must send quarterly account statements to clients, the investment advisor themselves is not required to do so if the qualified custodian provides them directly. Key requirements for advisors with custody include notifying the administrator, maintaining separate client accounts, and undergoing an annual surprise examination to verify assets. This ensures a system of checks and balances to protect client assets from misuse, similar to how a bank is audited to ensure deposits are safe. Remember, if a qualified custodian is involved, they are responsible for the statements, not necessarily the advisor. Question 2. Which of the following best describes the primary characteristic that differentiates an investment advisor from a broker-dealer under the Uniform Securities Act? A. An investment advisor charges commissions, while a broker-dealer charges fees. B. An investment advisor buys and sells securities as a principal, while a broker-dealer trades on an agency basis. C. An investment advisor provides advice for compensation, while a broker-dealer effects securities transactions for others. D. An investment advisor manages discretionary accounts exclusively, while a broker-dealer only handles non-discretionary accounts. Answer: C. An investment advisor provides advice for compensation, while a broker-dealer effects securities transactions for others. The core distinction between an investment advisor, IA, and a broker-dealer, BD, lies in their primary function and how they interact with clients regarding securities. An investment advisor, as defined by the ABC test, advice, business, compensation, is in the business of providing advice about securities for compensation. Conversely, a broker-dealer's primary function is to effect securities transactions for the accounts of others, often earning commissions or markups/markdowns on these trades. For example, if you seek professional guidance on which stocks to buy, you're likely talking to an investment advisor, whereas if you simply want to execute a trade, you'd go through a broker-dealer. Understanding these roles helps clarify which regulatory framework applies to a particular financial professional. Question 3. An analyst is evaluating a company by examining its financial statements, management team, industry position, and economic outlook. This approach is characteristic of which type of security analysis? A. Technical analysis. B. Quantitative analysis. C. Fundamental analysis. D. Modern portfolio theory. Answer: C. Fundamental analysis. Fundamental analysis involves assessing a security's intrinsic value by evaluating underlying economic, industry, and company-specific factors. This approach typically includes reviewing financial statements like the balance sheet and income statement, understanding the company's management quality, analyzing its competitive landscape, and considering broader economic trends to determine if a stock is overvalued or undervalued. For instance, an analyst might study a company's earnings per share and debt-to-equity ratio to gauge its financial health. The keyword, intrinsic value, is often associated with fundamental analysis, as it focuses on what a company is truly worth rather than just its market price trends. Question 4. When recommending investments to a client, an investment advisor's primary obligation is to ensure the recommendation is suitable. Which of the following factors is least important when determining the suitability of an investment for a client? A. The client's investment objectives and risk tolerance. B. The client's financial situation, including income and net worth. C. The current market price of the investment compared to its 52-week high. D. The client's time horizon and liquidity needs. Answer: C. The current market price of the investment compared to its 52-week high. Suitability requires an investment advisor to recommend investments that are appropriate for a client's specific financial situation, investment objectives, and risk tolerance. While the 52-week high and low are pieces of market data, they are generally less critical than the client's personal circumstances like their income, net worth, goals, time horizon, and ability to take on risk. For example, recommending a high-growth stock to a retired client seeking income and capital preservation would likely be unsuitable, regardless of the stock's recent price movements. The focus of suitability is always on the client's individual needs and characteristics, ensuring their portfolio aligns with their life goals. Question 5. An investor is considering purchasing shares in a mutual fund and wants to understand the different share classes. Which of the following best describes the primary difference between Class A shares and Class B shares? A. Class A shares have a contingent deferred sales charge, CDSC, while Class B shares have a front-end load. B. Class A shares generally have lower expense ratios and a front-end load, while Class B shares have a CDSC and higher expense ratios. C. Class A shares are typically offered to institutional investors, while Class B shares are for retail investors. D. Class A shares are suitable for short-term investors, while Class B shares are designed for long-term investors. Answer: B. Class A shares generally have lower expense ratios and a front-end load, while Class B shares have a CDSC and higher expense ratios. Mutual fund share classes are designed to offer investors different ways to pay for the costs associated with the fund, primarily sales charges and ongoing expenses. Class A shares typically have a front-end load, meaning a sales charge is paid at the time of purchase, but they generally have lower ongoing annual expense ratios. In contrast, Class B shares usually do not have a front-end load but impose a contingent deferred sales charge, CDSC, if shares are sold within a certain period, and they tend to have higher ongoing expense ratios. For example, an investor planning to hold a fund for many years might prefer Class A due to lower ongoing fees, while someone who might need to sell sooner might initially prefer Class B, despite the potential CDSC. Always consider the total cost of ownership over your intended investment horizon when choosing share classes. Question 6. Under the Uniform Securities Act, which of the following is generally considered an exempt security? A. A common stock listed on the New York Stock Exchange. B. A bond issued by a publicly traded corporation. C. A municipal bond issued by a state or local government. D. An investment contract sold through a crowdfunding platform. Answer: C. A municipal bond issued by a state or local government. Exempt securities are those that are not required to be registered with state administrators, although they are still subject to anti-fraud provisions. Securities issued by government entities, such as state and local governments, municipal bonds, are generally exempt from state registration requirements due to their public purpose and inherent trustworthiness. For instance, a bond issued by a city to fund a new school is exempt, while a common stock from a regular company is usually not, unless it's already registered on a major exchange, which could be a federal covered security and thus exempt from state registration. Understanding exempt securities is crucial because it affects the regulatory burdens for their issuance and sale. Question 7. An investment advisor discusses various risks with a client. The risk that an investment's value will decrease due to a general decline in the financial markets, regardless of the specific investment's fundamental strength, is known as A. Business risk. B. Liquidity risk. C. Systematic risk. D. Unsystematic risk. Answer: C. Systematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk inherent to the entire market or market segment. It cannot be eliminated through diversification because it affects all investments to some degree, stemming from broad economic or political factors. An example of systematic risk is a widespread recession that causes most stock prices to decline, regardless of individual company performance. In contrast, unsystematic risk, or specific risk, relates to a single company or industry and can be mitigated through diversification, like the risk of a specific company's product failing. Remember, systematic risk is the system-wide risk that affects everyone in the market. Question 8. When performing a fundamental analysis of an equity, an analyst uses a valuation model that discounts all future expected dividends to their present value. This technique is known as the A. Price-to-earnings (PE) ratio. B. Dividend discount model (DDM). C. Capital asset pricing model (CAPM). D. Free cash flow to equity (FCFE) model. Answer: B. Dividend discount model (DDM). The dividend discount model (DDM) is a quantitative method used for valuing stocks, particularly common stocks, based on the theory that a stock's intrinsic value is the present value of all its future dividend payments. This model assumes that dividends are the primary source of investor return and that these future cash flows can be predicted and discounted back to today's value. For example, if a company is expected to pay consistent dividends indefinitely, the Gordon growth model, a variation of the DDM, might be used. The DDM is a classic tool for valuing mature companies with stable dividend policies. Question 9. Under the Uniform Securities Act, an investment advisor is deemed to have custody of client funds or securities if the advisor A. Possesses client funds or securities, or has authority to obtain possession of them. B. Receives advisory fees directly from client accounts. C. Has discretionary trading authority over client accounts. D. Provides investment advice to clients for compensation. Answer: A. Possesses client funds or securities, or has authority to obtain possession of them. An investment advisor is considered to have custody if they hold client funds or securities, or have the legal ability to access or take possession of them, even if not physically holding them. This typically includes arrangements where an advisor can withdraw funds from a client's account, such as through a power of attorney or if they are authorized to hold client mail containing securities. For example, if an advisor keeps physical possession of a client's stock certificates, they have custody. Having discretionary trading authority, option C, allows an advisor to execute trades without prior client approval but does not automatically imply custody of assets. Custody triggers heightened regulatory requirements to protect client assets from misappropriation. Question 10. A client is concerned about the risk-adjusted return of their portfolio. Which of the following measures would an investment advisor most likely use to evaluate how much return the portfolio generated for each unit of risk taken? A. Alpha. B. Beta. C. Sharpe ratio. D. Standard deviation. Answer: C. Sharpe ratio. The Sharpe ratio is a widely used measure that calculates the risk-adjusted return of an investment or portfolio. It quantifies how much excess return above the risk-free rate, an investment provides for each unit of total risk, standard deviation, taken. A higher Sharpe ratio indicates a better risk-adjusted performance. For example, if portfolio A has a Sharpe ratio of 1.5 and portfolio B has a Sharpe ratio of 1.0, portfolio A is considered to have generated more return per unit of risk. Remember, the Sharpe ratio helps investors compare different investments on a level playing field by factoring in their volatility. Question 11. An investor is comparing two types of pooled investment vehicles, open-end investment companies and closed-end investment companies. A key distinction is that A. Open-end funds trade on exchanges, while closed-end funds are redeemed by the fund. B. Open-end funds can issue an unlimited number of shares, while closed-end funds have a fixed number of shares outstanding. C. Open-end funds are actively managed, while closed-end funds are passively managed. D. Open-end funds are priced at their net asset value, NAV, throughout the trading day, while closed-end funds are priced once daily. Answer: B. Open-end funds can issue an unlimited number of shares, while closed-end funds have a fixed number of shares outstanding. The primary distinction between open-end and closed-end investment companies lies in their capital structure and how their shares are traded. Open-end funds, commonly known as mutual funds, continuously issue new shares when investors purchase them and redeem existing shares when investors sell them back to the fund, leading to a fluctuating number of shares. Their price is based on the net asset value, NAV, calculated once daily at market close. Conversely, closed-end funds issue a fixed number of shares during an initial public offering, IPO, and these shares then trade on stock exchanges like regular stocks, meaning their market price can deviate from their NAV based on supply and demand. Think of open-end funds as a spigot that can be turned on or off for new shares, while closed-end funds are like a company that has issued a fixed number of shares and trades them on the open market. Question 12. An investment advisor recommends a series of transactions to a client solely to generate higher commissions for the advisor, without regard for the client's best interest. This unethical practice is known as A. Commingling, B. Churning, C. Front-running, D. Reverse churning. Answer: B. Churning. Churning is an unethical and illegal practice where an investment advisor or broker excessively trades in a client's account primarily to generate commissions or fees, rather than to achieve the client's investment objectives. This activity is a breach of an advisor's fiduciary duty and can significantly erode a client's capital due to transaction costs. For example, if an advisor repeatedly buys and sells the same security in a client's account without a clear investment rationale, it could be evidence of churning. The key is excessive trading motivated by the advisor's gain, not the client's benefit. Question 13. An investor sells a stock for a profit after holding it for less than 1 year. How will this profit generally be taxed for a U.S. individual investor? A. As a long-term capital gain. B. As ordinary income. C. As a qualified dividend. D. As tax-exempt income. Answer: B. As ordinary income. In the U.S., profits from the sale of an investment held for 1 year or less are classified as short-term capital gains. Short-term capital gains are generally taxed at the investor's ordinary income tax rate, which can be significantly higher than the preferential long-term capital gains rates. For example, if an investor buys a stock in January and sells it at a profit in October of the same year, that profit will be added to their other income, like salary, and taxed at their marginal income tax bracket. Understanding the difference between short-term and long-term holding periods is crucial for tax planning. Question 14. Which of the following analytical techniques primarily focuses on historical price and volume data to predict future market trends? A. Fundamental analysis. B. Bottom-up analysis. C. Technical analysis. D. Quantitative analysis. Answer: C. Technical analysis. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. Technical analysts believe that past price movements and patterns can predict future price movements. They use charts, indicators, and trends to identify potential entry and exit points for trades. For example, a technical analyst might look for a head and shoulders pattern on a stock chart to anticipate a price reversal. The keyword historical price and volume data is a strong indicator of technical analysis, contrasting with fundamental analysis, which focuses on a company's intrinsic value. Question 15. A client is considering an investment that obligates them to buy or sell a specific commodity or financial instrument at a predetermined price on a specified future date. This describes A. Forward contract. B. Futures contract. C. Option contract. D. Swap agreement. Answer: B. Futures contract. A futures contract is a standardized legal agreement to buy or sell something, a commodity, currency, or financial instrument, at a predetermined price at a specified time in the future. These contracts are typically traded on organized exchanges, are highly liquid, and involve daily mark-to-market adjustments. For instance, an investor might enter into a crude oil futures contract to lock in a price for a future delivery of oil. While similar to forward contracts, futures are standardized and exchange-traded, reducing counterparty risk. Remember that futures implies a standardized, exchange-traded agreement for a future transaction. Question 16. Under the Uniform Securities Act, an individual who provides investment advice for compensation and is employed by a registered investment advisor is generally defined as an A. Investment advisor. B. Broker-dealer. C. Investment advisor representative, IAR. D. Agent of a broker-dealer. Answer: C. Investment advisor representative, IAR. An investment advisor representative, IAR, is an individual who represents a registered investment advisor, IA, in providing investment advice to clients. This includes individuals who manage client accounts, determine advice given to clients, or solicit, offer, or negotiate for the sale of investment advisory services. For example, a person working for an advisory firm who directly meets with clients to discuss their portfolios and provide recommendations would be an IAR. The key is that the individual is employed by or associated with a registered IA and performs advisory functions. Question 17. Which of the following financial statements provides a snapshot of a company's assets, liabilities, and owner's equity at a specific point in time? A. Income statement. B. Cash flow statement. C. Balance sheet. D. Statement of retained earnings. Answer: C. Balance sheet. The balance sheet is a fundamental financial statement that presents a company's financial position at a single, specific point in time, much like a photograph. It adheres to the accounting equation, assets equals liabilities plus owner's equity. Assets are what the company owns, liabilities are what it owes, and owner's equity represents the owner's residual claim on the assets after liabilities are paid. For example, a balance sheet from December 31st would show the company's financial standing on that exact date. Think of it as a snapshot of a company's financial health at a moment. Question 18. Which of the following qualified retirement plans is designed primarily for self-employed individuals and small business owners, allowing them to contribute a higher percentage of their income than a traditional IRA? A. 401k plan. B. 403b plan. C. SEP IRA. D. KEO, HR, 10, plan. Answer: D. KEO, HR, 10, plan. KEO plans, also known as HR 10 plans, are tax-deferred retirement plans specifically designed for self-employed individuals and unincorporated businesses. They allow for much higher contribution limits than traditional IRAs, making them attractive for successful self-employed professionals or small business owners who want to save substantially for retirement. For instance, a freelance consultant might establish a KEO plan to shelter a significant portion of their business income from taxes. While SEP IRAs also serve self-employed individuals, KEO plans typically offer higher contribution limits based on net earnings. Question 19. A client is interested in an investment that offers professional management and potential for capital appreciation, but also provides a guaranteed death benefit and income stream in retirement. This describes A. Fixed annuity. B. Variable annuity. C. Indexed annuity. D. Mutual fund. Answer: B. Variable annuity. A variable annuity is an insurance contract that offers both an investment component and an insurance component. The variable aspect means that the investor's return depends on the performance of underlying investment subaccounts, which operate much like mutual funds, offering potential capital appreciation. The insurance features include a guaranteed death benefit, ensuring a minimum payout to beneficiaries, and the option to annuitize the contract into a stream of income during retirement. For example, an individual might use a variable annuity to save for retirement with growth potential while also securing a guaranteed income later in life. It combines investment growth potential with insurance guarantees. Question 20. Under the Investment Advisors Act of 1940, which of the following is the primary document filed by an investment advisor to register with the SEC or state securities authorities? A. Form 10-K. B. Form ADV. C. Form U4. D. Form BD. Answer: B. Form ADV. Form ADV is the uniform application form used by investment advisors to register with both the Securities and Exchange Commission, SEC, and state securities authorities. This form provides comprehensive information about the advisor's business, including their services, fees, disciplinary history, and conflicts of interest. For example, Part 2A of Form ADV, also known as the brochure, contains detailed information that must be delivered to clients. Filing Form ADV is a critical step for any investment advisor to legally operate and provide transparent information to regulators and the public. Question 21. An analyst is trying to determine the current value of a future cash flow. Which concept would they apply? A. Future value. B. Present value. C. Compound interest. D. Discount rate. Answer: B. Present value. Present value, PV, is the current worth of a future sum of money or stream of cash flows given a specified rate of return. The concept of present value is fundamental in finance because it allows investors to compare the value of money received at different points in time, accounting for the time value of money. For example, determining how much money needs to be invested today at a specific interest rate to reach a future goal, like buying a house, involves calculating the present value of that future sum. The term discounting future cash flows back to today is synonymous with calculating their present value. Question 22. A client approaching retirement is concerned about outliving their savings and wants to ensure a guaranteed income stream for the rest of their life. Which of the following financial products is specifically designed to address this concern? A. A 401k plan. B. A Roth IRA. C. An immediate annuity. D. A mutual fund. Answer: C. An immediate annuity. An immediate annuity is an insurance product designed to convert a lump sum of money into a guaranteed stream of income payments that begin immediately, or within 1 year, and continue for a specified period or, more commonly, for the rest of the annuitant's life. This directly addresses the concern of outliving savings by providing longevity protection. For example, a retiree might use a portion of their 401k rollover to purchase an immediate annuity, securing a predictable monthly check. The key function of an annuity, especially an immediate one, is to provide guaranteed income during retirement. Question 23. An investment advisor is explaining different types of real estate investments to a client. Which of the following vehicles allows investors to gain exposure to real estate without directly owning property, while also offering liquidity and potential dividend income? A. Direct real estate ownership. B. Limited partnerships. C. Real estate investment trusts, REITs. D. Mortgage-backed securities, MBS. Answer: C. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are companies that own, operate, or finance income-producing real estate. They are structured in a way that allows individuals to invest in large-scale income-producing real estate properties, such as apartment complexes, shopping malls, or office buildings, by purchasing shares in the REIT. REITs trade on major stock exchanges, providing liquidity that direct real estate ownership does not, and they are required by law to distribute at least 90% of their taxable income to shareholders annually as dividends. For example, Buying shares in a healthcare REIT allows an investor to participate in the performance of medical facilities without the burden of property management. Question 24. An investment advisor becomes aware that a significant number of their clients have placed buy orders for a thinly traded stock. The advisor then places a buy order for their personal account in that same stock before the client orders are executed, aiming to profit from the anticipated price increase. This unethical practice is known as A. Insider trading. B. Painting the tape. C. Front running. D. Spoofing. Answer: C. Front running. Front running is the unethical and illegal practice where a broker or an investment advisor places an order for their own account after seeing a pending client order, with the expectation that the client's order will move the market price in a favorable direction for the advisor's personal gain. In the example, the advisor used knowledge of client buy orders to buy the stock for themselves first, intending to sell it at a higher price after the client orders pushed the price up. This is a clear breach of fiduciary duty as the advisor is putting their own interests ahead of the client's. Question 25. The efficient market hypothesis, EMH, suggests that financial markets are efficient in processing information. According to the strong form of EMH, which of the following statements is true? A. Publicly available information is quickly reflected in stock prices, but insider information can still be used to earn abnormal returns. B. Historical price patterns can be used to predict future prices, but fundamental analysis is ineffective. C. All information, public and private, insider, is immediately and fully reflected in stock prices, making it impossible to consistently achieve abnormal returns. D. Neither technical nor fundamental analysis can consistently generate abnormal returns, but market anomalies occasionally exist. Answer: C. All information, public and private, insider, is immediately and fully reflected in stock prices, making it impossible to consistently achieve abnormal returns. The efficient market hypothesis, EMH, proposes that asset prices fully reflect all available information. The strong form of EMH is the most stringent version, asserting that all information, both public and private, insider, is immediately and fully incorporated into stock prices. This implies that no investor, not even those with access to non-public information, can consistently achieve abnormal returns because the market instantly reflects even undisclosed data. For example, if the strong form held true, even knowing about an impending merger before it's announced wouldn't allow you to profit, as the market price would already discount that information. This concept challenges the effectiveness of both fundamental and technical analysis, as well as insider trading.